fantastic discussion coming up next on private equity outperformance. I'm very pleased to hand over the reins for chairing this panel to Sachin Khajuria. He's the author of a best-selling book called 2 and 20. You may have heard of it. It's the inside track on private equity. And I understand that the US Senate has just ordered 1,000 copies. It's also been bought by the White House and the Treasury. So if you're looking for a canary in the coal mine, then potentially Sachin's book is it. So Sachin, please bring your panelists up to the stage and make a start.
Hello, is it on? Yeah, great. Thank you everyone for joining. Thank you for staying, I guess, for most of you who are still here. So this panel today is about how GPs and LPs can have an open dialogue and how LPs can find outperformance in their private equity managers. So how do you find managers that are going to outperform? And I'd like to start by introducing our panelists. And so if you could start at the beginning, maybe Bjorn, and tell us a bit about who you are, what you do, and some of the key numbers behind your role.
Sure. Good afternoon, everybody. My name is Bjorn Walsman. I'm Managing Director at Wilshire. We manage roughly 30 billion in assets in private markets that we invest on behalf of our clients.
Great. Hi, everybody. And first of all, thank you so much for seeing this out to the bitter end. We were somewhat worried that we wouldn't have anybody in the room, but hooray, you're all here. So my name is Amy Dupe. I'm a managing director at Goldman Sachs, and I co-head our private equity primaries business, which is our private equity fund of funds business. So that's a business that's been around for over 25 years now. And what we're doing is we're investing globally in private equity funds which span buyout, growth equity, and venture, picking funds and putting them in private equity portfolios that we manage on behalf of a mixture of clients, both clients that are institutions as well as clients that come from our private wealth management channel.
Thanks, Amy. Meher Shah, Managing Director, GCM Grosvenor. I lead our European private equity business. GCM is a 70+ billion alternative asset management across a number of strategies, from hedge funds all the way to private equity, infrastructure, and real estate. Private equity being the largest of around $30 billion. We deploy similar to Goldman, primaries, co-investments, and secondaries. A significant focus on the middle market and particularly growth. Pleasure to be here. Looking forward to speaking to you.
Thanks, Meher. I'm David Mullock. I'm a portfolio manager for the BP Pension Fund, which is one of the UK's larger pension funds. I cover private equity, and we invest in buyouts, venture, and growth across the spectrum there. The program's been going for some time, since 2002. Relatively mature program, and looking forward to speaking to you today.
Great, thank you very much. So in addition to my COVID project of writing a little book, my main job is I run our family office. So I'm a direct LP across most of the major private equity firms, funds, private equity credit, and so on. And so I hope you find the questions interesting. They're pretty much inspired by the sort of things I think about when I'm making decisions on my allocations. So the first one, and I'm going to ask David this to you, how do investors manage their PE exposure, looking not only at the macro environment today, which is very challenging, but also looking back a bit through the COVID-19 pandemic?
Sure, no, thank you. I guess starting really at the start, the kind of the asset allocation that we have towards private equity is really driven from as many are, a combination of top-down views and a focus really on risk, return, and increasingly cash flow on top of that as well, on liquidity. And then we ourselves within the private equity team tend to build a portfolio building in factors such as check size, pace of re-ups, and really also the kind of the strategies that we're looking to build within those those kind of criteria. In terms of the way that we've done that, I mean, really we've focused in particular on certain sectors. We've got a relatively strong tech vertical, a relatively strong healthcare vertical, and where we've done other kind of managers in the generalist space, we've tended to look for niches, look for competitive advantages that we think are repeatable. In terms of the way that allocation really developed over COVID, I think certainly to start with, I think the immediate kind of impact as COVID hit, we were in, I think, a relatively good position practically. We'd actually just completed a couple of due diligences that we were in write-up mode. We'd already done some kind of Zoom remote diligences, so we were in relatively quite a good spot for that kind of part of the crisis as it immediately hit. What I think is probably slightly more, a slightly broader statement is that I think during that initial kind of period of COVID where there was uncertainty, no one was kind of exactly sure where the marks would be. I think for the most part, I think LPs had learned really from the crisis in terms of kind of following through on their commitment programs and really kind of understanding the benefits of regular, consistent programs. And that's true, I think, not just of the PE teams and the actual direct LPs, but also the apparatus around the private equity team, CIOs, advisors, the advisory community. And I think that worked relatively well. The current environment is again, with volatility in many markets, now it is more challenging as to how do you kind of keep your deployment pace at
Do you see yourselves leaning in? I mean, you mentioned tech, you mentioned healthcare, challenging macro, S&P down 20%. Are you leaning in more? And you think about allocations in the next 12 months?
No, we are kind of we're constantly tweaking how we look at the program, but really, I mean, we've built the program on consistency of strong kind of long-term relationships over a number of years that have generated access, generated good returns. And one of the good things about a pension fund is the liabilities are relatively long-term, so we get that opportunity to invest through cycles as well.
So I'm going to turn to Mayur as well. Same question, if I can, on managing PE exposure in the current climate, and if you need to look back a little bit through COVID.
Yeah, no, absolutely. I mean, we are all relatively sophisticated investors, I would say, both here and on the panel. And so, managing exposures is a mixture of art and science, I would say. We have three types of clients. Pension plans, both public as well as corporate pension plans, who have different ranges of where they want to and allocate to the PE class. We have seen through COVID actually, somewhat surprisingly, but refreshingly good that they were continuing to invest through the cycles. What we're seeing recently is a little bit of softening in deployment, just as they ascertain and figure out what's actually going on in the current macro and respect to the public markets, which is very much their kind of pillar and point which they look at from a private equity standpoint. The second type of client typically is large sovereign wealth funds, and look, typically what we see there is actually in times of potential distress or market dislocation, they double up. There is a significant opportunity. Recession vintages tend to be the best performing vintages, and so we see significant continued deployment in that space. And then the third is more family offices who I'd say are a little bit more nimble and can be reactive, and you can have a more direct conversation and more opportunistic in nature. And here, they are particularly find appealing is deals, direct deals, co-investments, because they can fit specific sectors or types of strategies that they don't have in their current exposure. So it's really managing what you have and what you want going forward. Typically, we're seeing a large portion of our clients in North America. The current FX volatility is very, very challenging. You'll see, recent dollar sterling, dollar euro. So that's very, very important consideration and has been, and that does cause some uncertainty. But typically we say, you should invest through the cycles and maintain consistency because it's very difficult to time the market. We do see some investors exploring secondary sales. The GP-led phenomenon has enabled some exit activity, so that has actually enabled people to recommit, especially in the year that we've had in terms of the re-ups that we've had to commit to. So it's a different level of exposure and different level of clients' needs, and to manage that, and we kind of have a very interactive approach with them.
Thank you. So second question, looking at how you identify managers with the potential to outperform, how LPs can identify managers in this climate going forward with the potential to outperform. I may start with you, Amy, if I may.
Yeah, happy to. And this is obviously a very broad topic, and there are lots of different things that always have to be taken into consideration when picking managers. But I think we are at a very interesting point in time. And if you look back at the private equity industry over time, there have been these big movements and the model's been moved forward in different ways. And so if we went back 10 years ago, we started to see private equity managers introducing operating capabilities to a greater extent. We saw them placing greater emphasis on developing in-house sector expertise. And these are all ways that managers at those moments in time were seeking to evolve and adapt to a changing environment. I think now's a really interesting juncture because obviously a lot's been said, lots been written about how much capital has been raised in the space. Certainly private equity today is much more competitive than it ever has been historically. So what that means is that private equity managers again have to think about how they can move things forward and compete in this different environment. So what are going to be the magic things that managers can do? So as always, it's probably a little bit of everything has to get better. But I think one of the areas that we're particularly interested to seeing how it evolves is all things related to tech. And so as David was saying, a lot of LPs have increasingly focused on tech and very consciously made sure that they've got increased tech exposure in their portfolios. But what we haven't necessarily seen yet is a greater embracing of tech at the manager level. So specifically, how does tech play a role when it comes to sourcing, doing the diligence, driving value creation, doing the sector research? All of that still has the potential to be revolutionized by greater integration of tech and data science. So certainly we've seen some managers start to do it. I would say that, perhaps not surprisingly, a lot of the venture managers have been at the forefront when it comes to developing systems and proprietary tools to help with sourcing. But I think our view is that you can definitely see that that's got some way to go. And then, of course, the other angle of it is on the value creation plan. And the kind of the joke is there's no business that's not a tech business anymore. So whether it's an industrials business or anything that you wouldn't typically associate with tech, now it seems that there's always some tech angle or digitalization angle. And of course, if that's not an area that you as a GP has focused on historically, you need to develop that expertise. So in summary, what we're trying to do today is figure out how managers are adapting and evolving such that in a more competitive environment, not to mention a more challenging macro environment, why is it that they're still well positioned to perform and outperform specifically?
Thank you. I mean, I'll give you one criteria that I use. I made 6 allocations in the last 12 months across North American managers and European managers, and infrastructure, real estate, secondaries, buyout, a lot of things for our family office. And one of the key things that I look at, I actually call the library, which is data science. And it sounds a little bit like, yeah, isn't that for back office? Or really, how do you measure that? But the more you ask managers about how they're investing in data science, the more you realize what they're really doing is mining the enormous amounts of data they have across not only their operating portfolios, but across the management teams. So I wasn't going to name names, so I'll name one name. At Blackstone, as I'm LP at Blackstone. And we get like these heat maps of what's happening across the economy. It's pretty amazing, actually. And they're aggregating data. Of course, there's a lot they have to filter out because I'm an LP, not in the GP. But at the same time, it gives me a really good perspective of the key questions they're asking. They're polling almost bunches of CEOs. And if you look behind that, they hold these information sessions. And I'm not plugging what they do. There are lots of other firms that do the same. They're holding these information sessions for LPs about this is how we're using data science. And the reason that's important is when things start to go wrong, because right now you're going to see, you may not see it in dispersion of marks, but you'll probably start to see it in dispersion of operating metrics. They can actually start to draw on more data than other firms by saying, okay, this consumer business is going wrong, this energy business is going right or wrong. How can we mine the data that we've accumulated over the last 25 years on this particular angle? And I think it really helps, because at the end of the day, all these firms have very smart people with good backgrounds, but I think that's a big differentiator. So I'd agree very much with your point on tech. Bjorn, same question if I can on identifying managers who can outperform.
Yeah, sure. I think first of all, it's good that there's a little bit of stress currently, because just walking around at the conference, there are so many GPs with very impressive performance numbers. So it's really difficult to decide on who to invest with, especially where we are today, because everybody looks good. So who are you going to pick? So I think that's, in a sense, also a benefit to what we are currently seeing in the market. In terms of marks, performance numbers have not come down a lot. In the venture space, we've seen that some private company valuations have been impacted, given the tech crunch we've seen in the public markets, especially, for example, in fintech. But how do we look then at the managers that we select? First of all, our philosophy is that we always say it's manager over market. So even in underperforming markets, there are managers that will outperform. And what's then the special sauce that they need to have? And I think we touched upon it already. It's a little bit, you need to have a certain expertise, whether it's a sector expertise, or it's your expertise in buying value, or in basically being really good at identifying add-ons to your platform companies that you can buy at relative value. So that's where we say you need to have a right to own an asset and be the natural owner. And that's really key. And then, if that's the case, the expectation is also that you will on average do better than other general partners, other fund managers that are out there. So in that sense, technology is key. Is one of the themes that we've been looking at a lot. Also healthcare. I think a lot of people have been looking at buying exposure into those sectors, but then still is, what manager are you going to invest with?
Mayur?
One thing we spend a lot of time on in terms of whether that manager will continue to outperform is, obviously you have strategy, you have the track record, but a little bit of the softer aspects are just up to the team. I think, as we just discussed, performance has been very, very strong with the managers, but potentially that could paper over some cracks if you're at slightly more distressed times going forward. And so whether those managers have really built out their capabilities, not on the investing side, but also on the operations side. We're spending a lot of time on the ESG, whether the integration from that perspective has actually now started coming through, as well as you have a lot of managers now ahead of HR. Talent is very, very important to make sure, the outperformance. And so we spend a lot of time on making sure the structure of the firm is well set for the upcoming 5 years, which is going to be more challenging. In particular, things like succession. Has that been managed? And so we spend a lot of time with the next generation of partners. We're a very active co-investor. We do a lot of co-underwriting. And so that enables us to really spend time with the individual deal teams over several hours on looking at transactions and doing diligence. And that's where we've seen be able to kind of, differentiate between a firm which on paper looks very good, but just really focusing on how they look at the deals and how they transact enables us to kind of differentiate and pick the managers that we want to go forward. So that's been a very key area of what we look at.
Thank you. David?
Sure. I think the area that I'd like to pick up on really is on strategy, and strategy is increasingly an area that we've been focusing on over a number of years. And if you see the way that kind of PE firms have developed over the past 5 years, whether that's the rise of sector funds, multi-sector funds who've kind of created sector teams within larger businesses, or even amongst the generalists who do repeat plays, you get this kind of sense of visibility on what might come in the next fund. And I think that's one thing LPs do try to focus on now. You've got to think better visibility on what might come in a fund compared to what you had, say 10 years ago, because you were either in a sector fund or even, say, at the generalist level. The repeat plays and the areas that they've built expertise is. are likely to come up again, or more likely to come up again. You can never tell, but the odds are better. And I think it's incumbent on LPs to actually kind of understand the tailwinds and the drivers behind those individual subsectors and niches that the GPs focus on, as they can actually really be kind of true drivers of return. And that level of expertise can often help in terms of generating outperformance.
So it's interesting, a number of you mentioned tech and healthcare. Going to product, interestingly, despite the macro climate, nobody's talked about distressed. Distress can mean lots of different things, and it's easy just to throw it out there. I've done quite a lot of distressed, and I'm getting more and more coming on the radar. But does anyone want to pick up on looking for outperformance by focusing a little bit more on those who do distress in whatever form that means distress to you? I'll leave that up. Mo, you want to take that?
Sure. I mean, distress, as you said, can mean many, many things. And then the risk spectrum and therefore the return spectrum could also be varied. I think what we found most interesting is situations where the industry is in a good condition, or sorry, the business is in a good condition, the industry is in a good condition, but there's a complex scenario with respect to the shareholding structure, or for whatever reason there's some leverage, etc., that needs to be solved. The complex situations provide very, very good opportunities for value creation. In particular, we look at and we've seen a significant return advantage from doing carve-outs. There are a lot of companies that are, effectively orphaned, part of large corporates where they're not getting the tender love that you would do if they were independent, and so carving those companies out, which is effectively a way of calling it a distressed opportunity, and really working with the company, professionalizing the management team, bringing in potentially a new management team, and then growing that into a successful independent company, we have seen quite a significant area of value creation, specifically to get some kind of multiple arbitrage at exit. The special situations, the pure distressed equity turnarounds, this is for sure their time to shine. They've probably had a slightly more difficult time over the recent years, given the QE, given the low inflation environment, but given the challenges that we all know, specifically, if you have dry powder right now and you are an equity turnaround investor, you're almost you're kind of rubbing your hands, because there will be most likely a lot of opportunity in 23, 24. But back to my point on team, the skill set required for these type of distressed opportunities is so different to regular buyout growth investing, and so you have to have the experience. You can't be a newcomer into doing this, and so that's very, very important and relevant.
Did you want to pick up on them, Bjorn?
Yeah, so the way we look at it, historically, it's been very difficult to find great turnaround fund managers or really distressed fund managers, for the reason that it's not so scalable in our view. So, for example, in turnarounds, you can only deploy, sometimes you see the €1 deals or you see small deals. There are a couple of bigger brands in Europe that have bigger funds, and also returns have been not per se always top quartile, not the best performance numbers, because it's very complex. You need to have this special skill set to really turn around a distressed company. So it's not so easy to do. The opportunity set is relatively limited, and then if they perform, typically the fund terms are also very expensive. So that's what we've seen in equity. If you talk about, I think, private credit, and there, yes, we see more opportunities, and there also our program is more tailored towards special situations, more distressed credit, opportunistic credit. Is that still special situations is a question mark. But yes, there we see a bigger opportunity to invest in distressed opportunities.
I'll pick up on that. I mean, I think one of the most attractive risk returns right now that I'm doing is, you can call it whether you call it hybrid value, you could call it intermediate or special situations. Some firms call it tactical opportunities. Is getting more protection on the downside, but giving a little bit up on the upside. So the band of outcomes is around, I'd say net of everything, all fees, all expenses, all everything. The band of outcomes is probably around 1.3 to 1.7, right? And if they do really well, you get a double. but you'll get somewhere in the teens IRR. However, the probability of losing capital is very low. So I think that feeds a little bit into what Mario was saying and what you're saying on, broadly defined special situations. But I think, and I'd encourage everyone to look at it, that sort of intermediate strata of hybrid capital or tactical opportunities, I've found, and certainly when I look at the marks and I look at the operating numbers behind those marks, that is very, very interesting at this point. Anyone else want to pick up on that?
Sure, yeah. I guess really I think the question around kind of what was traditional distressed is essentially what do you do when it isn't there or you can't find it, and that effectively widens the conversation towards value. And all these things I think that we're talking about are essentially value-orientated strategies, such as carve-outs, such as the kind of the hybrid models as well. And the good bit about it is that there are kind of differentiated ways to make money and differentiated return drivers that those kind of strategies bring. So you get some kind of diversification in the factorials that drive return.
I mean, if you look at value, and Bjorn, we can have a chat after about some of the managers who can do distress reasonably well. I think you are moving to an environment where if you do have a DNA of, where purchase price matters, that is really something very, very attractive going forward, and it probably is one of the most obvious ways to play the next few years, because very few people have worked in an investing environment where interest rates are, where they are, and especially where they're headed. Very, very few people, myself included, where you're starting to invest where rates are, kind of 4 going on plus %. And so when you have that, when you have stubborn inflation, and you have, I'd say the equity cushion is volatile, because the equity cushion ahead of whatever debt you've got or debt you're able to raise, if you're able to raise debt, I'm talking about buyouts now, means that you need to have managers who have really good value discipline. So I think, I would personally say, and this is, we're all creatures of our own experience, I guess, is that when I look at managers with the potential to outperform now, I would definitely look, despite perhaps how much you may have to pay to get them to do it, I would definitely look at sort of value distress plays. I'm going to change tack a little bit to our third question, and then we do want to take some questions if we can from the audience on rethinking allocations to private equity. This can mean a lot of different things. It can mean scaling up, it can mean scaling down. And I think you all have something to say on this topic. So I may start, Amy, with you on how LPs can rethink their allocations to private equity, in the market we've found ourselves in and going forward.
Yeah, so I'll look at it or talk about it in a slightly narrower fashion, in the sense that all my team does, all we're doing is just thinking about private equity, and we're not working with clients in terms of advising them on their broader portfolios. But that being said, I think one thing that we're very much of the belief is that even though, as I mentioned before, it's become a more competitive environment, the macro's got more challenging, we're still very much of the view that the levers by which private equity has historically driven good performance still are very much intact. And so first, the universe of investable opportunities is enormous. So of course we have the trends like companies staying private for longer. We've seen P2Ps come back. So globally, there's just a huge universe of investable opportunities, which is terrific because managers have at their disposal lots of different means of executing on their top-down views, picking great sectors, picking great management teams, etc. So I think that's important. Another consideration would be that, assuming that you're talking about buyout, a lot of the buyout strategies are control strategies, which means that you as the owner of a business really are master of your own destiny, in the sense that you get to position a business depending on what makes most sense for the prevailing environment. So that's a hugely powerful thing. And we saw over the course of COVID how so many different businesses changed and adapted to the new environment. And then thirdly, you also just still have the long duration of the asset class. So most funds still continue to have 10-year terms, which means that when you are the control owner of a business, you can look to do a lot in that period. So for all of those reasons, that's a big part of why historically private equity's been outperformed, and our view is very much that those things still persist, which is why we're excited. But ultimately, we've mentioned that we're coming into this environment where we're probably going to see more dispersion than we've seen for the more recent period. But that being said, you always have had dispersion. Every vintage year you get dispersion. So again, it's incredibly important that you are picking the right managers. A big part of that factors in what we had mentioned earlier in terms of partnering with managers who are nicely positioned for the future, making sure you get the top down right and focus on areas where there's likely to be better opportunities, make sure you get the right team. So I think we're under no illusion that this is going to be easy. Manager selection is going to be really hard, but if you can get it right, we still are very confident and optimistic that there's going to be good opportunities for very differentiated performance.
Björn?
Thank you. Yeah, so we are biased, of course. So yes, there's a big opportunity to invest in private equity. I think the hunting ground is a bit larger than in public equities. There are more private companies than there are public companies. I think that's one. Secondly, private equity has outperformed the public markets if you invest indeed on a continuous basis. So you get the liquidity premium, so you just outperform the public benchmark. I think the point that our clients are facing at the moment and the struggle is the denominator effect. And the question is how does it make sense to basically adhere to the fact that you only can have a certain exposure to private markets in your portfolio, whereas because what we're seeing now is that public pension funds or pension funds are just shedding their private markets exposure at the cost of basically the asset class that has outperformed the best. So are we looking at that in the right way? Yes, you may have a more balanced portfolio, but the question is for the right reasons. Having said that, because that's still blocking, I think, allocations to private equity, especially where we are today. But yes, we are obviously of the belief that there's room to increase allocations to private equity.
I think it goes to what is balance, right? Rebalancing to what? And so I personally think that model is changing, where rather than saying, okay, I can't have more than 10, 15, 20% in so-called alternatives, if your liabilities are increasing, or let's say you're a pension fund and you're facing these demographics, you're going to end up having to increase the share of pie to private markets, just because otherwise you're just not going to get there, personally. Meyer, what do you think?
I mean, if you look at the last time there was this level of inflation and rate hikes going up that significantly, private equity still was kind of in its infancy. And so there's no real data to show how they really work in this environment. But then if you fast forward the last 10, 15, 20 years, there's a lot of data out there that shows that they have outperformed public markets relatively consistency. And as the data has also shown, the recession vintages tend to be the best performing. And if you look at it now, I think a lot of the skills that are within the firms, they're able to be more agile. A lot of the companies that they acquire have more bargaining power. And so they're able to navigate the kind of the headwinds that potentially they will see. And so, naturally, yes, of course, biased in the sense that we recommend, we would think that people should be increasing their allocations towards private equity. But we know it's sometimes different. Some of the big institutional plans, they have ranges, but with the denominator effect, they can't just automatically 1 year change their ranges. It takes 5 years, for example, for the board and everyone to get comfortable to increase their allocation to private equity. And then unfortunately, sometimes they miss the best vintages. And so it's an opportune time to think about allocations. I think you should be thinking about allocations all the time, not just when there's a systemic impact or effect in the macro. And one of the good things about private equity is it's a 3 to 7 year horizon for each company. And so most of our managers, deal teams, they will stress test the businesses for potential shocks. And so typically they can ride out the waves, and we're only valuing every quarter. The marks are quite stable. So it is a more interesting and more kind of consistent place to be.
So David, tell us the inside story of what BP Pension Fund is going to approve at its next investment committee.
Well, I think a slightly more broader comment than that is I think it's increasingly kind of well understood, as the guys say, on the return side. I think people understand the kind of returns and the makeup of returns and the potential to outperform the public markets that private equity can do. What I think still could be developed further on the kind of portfolio construction side is really understanding what is risk. if you think risk, return, and liquidity go into the equations on overall kind of asset allocation. And what kind of risk is in private equity is, I think, slightly less well defined, especially in terms of overall asset allocation models. We tend to be, kind of valued on a quarterly basis, not on a daily basis. That there's, the level of kind of volatility in PE compared to public markets is essentially measured differently. We tend to measure volatility by kind of intra-fund spread rather than necessarily through things like tracking error and information ratios. And so that kind of mismatch, I think, is potentially an area of interest as to how private equity fits into overall portfolio construction. And I think that, I know that there is some kind of work on developing that kind of thinking. Increasingly, I think many institutional investors, most investors in fact, are increasingly thinking about liquidity as well. Not just kind of duration of funds. I mean, private equity is, again, I won't repeat, but generally kind of very good for long-term liabilities, long-term asset classes, which really does kind of help in terms of driving return. But also, I think we're seeing, kind of some of the more mature schemes as a whole actually being, relatively strong in terms of delivering cash flow, in terms of delivering liquidity. For the most part, there are two real kind of criteria required to do that. Firstly, you have to be mature. And secondly, you have to be diverse. And if you are mature and diverse in your program, then generally you are likely to be net cash flow providers rather than net drawdown takers. And whether the overall portfolio construction models are, it's very difficult to actually kind of model that out because it is obviously more volatile than less reliable than, say, a fixed income instrument would be, but it is there. It is there, and whether that's kind of cash to pay pensioners, cash to pay insurance requirements, or whatever it is, private markets are mature, diverse private equity programs are providing cash that do so.
Thank you. So we're going to take some questions. We have maybe 5 or 10 minutes left, and there's going to be a parting comment I'd like each of the panelists to give their thoughts on, which I just thought of just now, which is, please give the audience one idea they should look at as they go away from this fantastic conference. But we'll save your answers until after we've done questions from the floor to give you a chance, and actually me a chance, because I'll try and answer it as well, to think about an answer. So does anyone have a question for any of the panelists, please? Anyone? Please, if you could just tell us your name, what you do, and who you'd like to direct the question to, if it's directed to anybody.
Yeah, sure. Name's Frederick Tui. I work with Cross Boundary, which is an emerging market investment advisory firm. Curious to follow up on the discussion about special situations. One of the trends we've seen in emerging markets because of volatility in returns and cyclicality is the establishment of permanent capital vehicles, or things with non-10-year, non-traditional timelines. Curious if that's something that you've been seeing in the GPs that you work with, and how that integrates into your approach to a portfolio.
Who would like to have a first crack at that question? All of you? Oh no, you're nominating each other. Okay, great. So, David, are you seeing any permanent capital vehicles creep into the BP allocation, particularly as regards emerging markets?
We haven't done a huge amount in emerging markets, and in terms of kind of permanent capital vehicles, we've as a relatively mature program, we've tended to kind of to stick to the more kind of traditional limited partnership type approaches, which have provided a fairly good alignment of interest in terms of generating those kind of distributions.
I'm a big fan of permanent capital, perpetual capital vehicles. I kind of look for those. I tend to look at ones that have quite a high running cash yield, or at least the potential for a high running cash yield. It's interesting you mention it in terms of emerging markets. Just before COVID, I was presented with what was described as the GP LP opportunity of the century by an unnamed bank, Amy. And it was a partnership between one of the big Chinese sovereign entities and this bank to invest in the Chinese market in buyouts and relied a lot on multiple expansion. And through the diligence, I realized it wasn't for me. It was for a lot of other people. A lot of people went into it. Obviously, it had a very difficult time through COVID. I'm not even sure it deployed much. But one of the questions that came up from one of the LPs, which I thought was a very good question, was why are you not doing this in a permanent capital setting where we could have a bit more visibility on what's going on? Anyone else want to reply to that? Björn?
Yeah, I think the only thing to add here, what we have seen is that in venture capital, there you see that a lot of early stage fund managers have also raised later stage funds to basically double down on the winners in the early stage funds, to also basically keep those assets in the portfolio longer and to benefit from the upside. In the buyout space, I think we've seen all the evolution and development of continuation vehicles where some of the best performing assets are being held for longer. I think that's what we've been seeing, but the closed-end structures we manage for our clients typically do not fit those longer hold periods.
Okay. Any other questions from anyone? Please. If you could just tell us who you are and what you do, it'd be great. Worst investments in the recent past and some color on that, I think was your question. And the reason you made the worst investment, or why it turned out to be the worst investment? Why it turned out to be the worst investment. So what was your worst investment and why was it the worst investment in the recent past?
I mean, the one I can think of that I wouldn't say it's my investment, but it's as but it's an investment that was made was they're a supplier to the airline industry, and they had a niche. They were an independent supplier, very good margins, and as you can imagine with COVID, that has significantly impacted the business, and so therefore the commercial traffic went to zero effectively during those kind of first few quarters of COVID, which has now picked up significantly. But that business then, had to have a restructuring involved because it wasn't appropriately, the costs and et cetera weren't appropriately set up within those businesses. And so that's taken a longer time to recover, despite the fact that the market has recovered. Hopefully there is light at the end of the tunnel, but that's been one of, being caught left field by the pandemic, which I'm sure some people have had experience with.
Thank you. Thank you for a very honest answer, Mayur. Anyone else? David, Björn, anything you've seen, Amy?
So I'm going to take the recent past as being up to the last decade, 8 years. I'd say that the theme, if we look across a few different investments which have not done what we'd expected, I'd say a common theme will have been situations whereby the external macro environment has overwhelmed whatever the manager has done. So in that bucket, put some of the emerging market investments that we've made, as well as things in the energy sector. So, who was going to know what was going to happen to energy prices in 2014? Who knew what was going to happen to FX in some of the South American countries? So lesson learned was that don't make an investment whereby the success is going to be principally driven by factors outside your control and the manager's core control.
Thank you. Björn?
Yeah, so we had the same experience indeed. But to take another example, it was a first-time fund being raised by a team that worked together. But they structured the economics in a way that at some point when they started raising their successor fund, there was disagreement in the partnership. Partnership blew up, assets were not properly managed, and at some point the GP had to be removed. And that obviously was not a very good investment. So I think the lesson learned there is that it's really important to make sure that the alignment is there and that you understand who's key to the strategy. Could we have foreseen this? Maybe we learned our lesson, but it was not a great investment.
Did you stop doing first-time managers after that?
We've become more skeptical, yes,
Right.
because you take a lot of organizational and team risk, and it does not per se pay off. So you want to be rewarded for the extra risk that you take. And you see some more established managers with great returns or similar returns. So why would you take on the additional risk? Yes.
David, anything that's been challenging in the BP portfolio?
Sure. I think broadly the team here is right. The things outside of your control, the macro environment, are the biggest risk factors on that. I think if I was to add something, I think the pace of technological change and the pace of disruption can also cause issues in some portfolio companies. It's the one thing that's also very, very difficult to predict as well. And often you in most cases you benefit from this, but it is possible to be disrupted as well as be the disruptor.
Thank you. I guess one of the advantages of private capital is you can always hold it longer. So as long as the investment doesn't blow up, hopefully they can turn it around. So I don't know if it's coincidence, but about 15 people have just come into the room when everyone's going to give the idea of the day. So I'll just start with one idea that I've done a lot of, but I look at a lot in this kind of macro climate, which is insurance, because it's basically correlated to a very different cycle than the macro cycle. It doesn't mean it's not cyclical. It has supply and demand of capital. But for anyone who's not looking at insurance or has never developed any expertise in insurance, I would certainly look at that because, for example, if I roll back to when I worked at a GP, very tough environment in the financial crisis, we did a lot in insurance, an enormous amount actually, in lots of different ways, simply because it was a very good way to put a lot of money to work. It tends to be less levered because you can't lever regulated entities in the same way as you can, for example, buyouts. And it ended up being a fantastic sector. So that's my idea of things for people to look at. Who wants to go next? One idea for the audience, for them to look at that you're finding interesting right now or you're doing research on.
Sure. I mean, I think maybe touching back on that idea in the whole portfolio construction, do look at, if you have those kind of mature portfolios, do look at how much net cash those portfolios have been kicking off. It's not guaranteed by any stretch of the imagination the way that other instruments are, but in what has been a relatively low interest rate environment, then private equity portfolios as a whole have actually provided much of the cash that supports the underlying reason for investment. And it's quite interesting to dig through and see, compared to other asset classes that are, have been in a relatively low yielding environment, that the actual kind of net cash flow from PE over time is has been very helpful.
Mario, one idea.
I think, whilst the last boom cycle technology was driving, significant amount of returns, I think we very much believe the next cycle, ESG and impact, will drive significant outperformance. And I think the good thing is, over the last 5-6 years, people have invested in it, but there's been a lot of kind of mistakes, lessons to be learned, both also with the regulators to understand, what people are reporting, monitoring, etc. But I think the industry now is in a much better position than it was 5 years ago, and I think it may be the next kind of growth, significant growth area. And so I think that's something that people should be looking at 5, 10, 15% of their portfolio going forward.
That's a pretty big allocation here, 5, 10, 15. Right. Amy.
So my suggestion would be to get more granular in terms of tech views. So we spend a lot of time talking about tech. Tech's a good exposure in portfolios, but given the growth in that segment of the market, you can now express it in lots of more nuanced views. And I think increasingly you're going to see more dispersion. So it's going to be more important to pick how you execute on it in terms of strategy. So do you do buyout, growth equity, and venture? And if it's venture, which stage? But also making sure that you are very mindful in terms of whether it's enterprise, is it fintech, is it digital health? There's going to be just more opportunities to differentiate by getting your granular tech views right.
That's a great answer. And to end our panel today, Björn,
Thank you.
big idea.
To invest in something that's uncorrelated to the current environment. So, for example, alternative yield. That's something we are focused on. It can be strategies like music royalties, NAV lending. Those are all less correlated to what we are seeing in the macro environment.
Thank you. Thank you to everyone on the panel. And I think we're done. Thank you very much.